Welcome back to the Privated podcast, where we spotlight extraordinary people and remarkable talent reshaping our world. Our guest today is Narasimha Krishnakumar, a financial technologist, quantitative developer, systematic trader, and the founder and CEO of QuantMomo. He brings more than 50 years across software engineering, product development, algorithmic trading experience. At QuantMomo, he has architected a multi-strategy rule-based system operating across the US and Indian markets with real-time data pipelines and automated execution work that includes live options, backtesters, futures engines, and IB API-driven execution. So QuantMomo's vision is to help retail investors follow disciplined, rules-based strategies, reducing the discretion, stress, and noise. So prepare for a very interesting episode today. Naramisha, how are you doing today?
Very good. First of all, thank you. Thank you for having me on this podcast. Really excited to be discussing QuantMomo and some of the things that we have done.
Yes, I find it very interesting what you're doing at QuantMomo. Can you describe it in layman's word? Like what are you doing?
Yeah. So, QuantMomo really, what does it mean, right? So many people ask, what does QuantMomo mean? So QuantMomo stands for quantitative momentum and more. QuantMomo was born, with a vision of, rules-based investing, making accessible rules-based investing for retail traders, for different types of audiences. So that's kind of how we began. I manage a portfolio of, about $2 million, and my goal was to let's look at various market conditions. How can we really generate alpha in the market? So that was kind of the driver for all of this. And then, we had episodes in 2008, 2020, 2001, where the market was down more than 50% at some point in time. And then, you don't know whether you want to keep your investments or you want to withdraw, liquidate. So there were multiple shocks, and the 2020 shock was enormous. The COVID shock we had, it was enormous. The market dropped about 30% within 1 week in March. And then, there was a lot of interventionist policies that helped the market bounce back, not only bounce back, but achieve double-digit returns in the market. So if you were a buy and hold investor and you were facing a 30% drawdown in 2020, you would be really, thinking about what do we do? Is this permanent or is this temporary? Will it come back? So that was kind of the foundation of QuantMomo. What do you do in environments like that? Are there strategies that you can use to really help you with environments like that, right? So that's kind of what we started with. And we looked at a lot of factor-based investments. There are various factors in market. Momentum is a factor, carry is a factor, mean reversion is a factor, size could be a factor. So there are a bunch of different strategies out there in the market that most of the big institutions use that are not accessible to the retail investor, right? So for me and for the group of people that I support, we don't have access to those, and you need to have certain network, and you need to really look at how you need to look at how you can enter that kind of a space. So what we did was to look at all of that, look at all the literature in the financial markets, and then come up with a set of strategies that can help investors generate alpha. And this is a multi-asset, strategy approach where you're allocating appropriately. One of the things that we do is enable retail investors to trade these strategies through a simple mobile app. So we started this journey in the US, and then in the US, there are a lot of opportunities with exchange traded funds that do similar things. So customers and investors can go buy exchange traded funds to participate in this kind of a factor driven model. In India, that's a brand new greenfield opportunity. And just to look at the market opportunity in India, you have about 1.4 billion people, with about 300 million middle class, and the pardon rate in the capital markets is pretty low in India. So we saw a huge growth opportunity in India. And one of the things that we could do from a multi-strategy approach is to use a very similar approach in India based on data. So whatever we do is based on data that we gather from the markets. We do extensive testing of our strategies, and then we simulate how the future could look like. And if the strategy holds, then we make it available to our investor audience. So that's available through a mobile app. The investor can use the mobile app, connect with their brokerage account, and trade their own capital. So that's kind of what we are facilitating through this investment management platform.
I'm wondering how, you were talking a little bit about the differences between the Indian market and the US market, right? Can you elaborate a little bit more on that?
Yeah, so yeah, definitely. So, India as an economy is, really on a growth pedestal. If you look at the gross domestic product that India produces, and the rate of change of growth is primarily around the 6% to 7% range. So that's kind of the growth that you're getting. And, you have a vast stock market, and you probably have read a lot of news about Jane Street entering India, and then, BlackRock Financial entering India with Geo Financial Services. So there is a lot of things happening in India. However, the markets are different in terms of the maturity level. I would say to my investors that, when you look at the markets in 1998, where we had the first online brokerage platform in the US, 1998, 1999, about 27 years ago, we are at that level in the Indian market, right? So we are about 5 years from 1988, 1998, 1999. So let's say we are in the 2005 range for the US markets in India right now. So lots of online brokerages are coming online. People are very educated about investments in the stock market. There's a lot of options trading that is happening. So people are very educated. So that's kind of one good thing. From a capital market perspective, there is a lot of opportunity in terms of the technology. Where I look at is technology, right? So, the brokerages, like, for a simple, let's take a simple example, right? So a trailing stop order, is not available with all brokerages in India, right? That is available with all brokerages here in the US, most of the brokerages in the US, but that's not available in India. So how do you really overcome some of the technological challenges that, exist? Because that's kind of evolving. They will get there eventually. And we are kind of a little bit more advanced from a technological development because you have had 20 years of development in the US, about 20 to 25 years of development, where all those capabilities have come into products and brokerage systems. So that's one of the fundamental differences. Then there is also differences from a regulatory perspective. In India for capital markets, one of the regulators is Securities and Exchange Board of India. Very critical role in terms of protecting investors as well as protecting investors that are not very good, and then protecting them from fraudulent actors that exist in the market. Right. So they have a very critical role, and the regulations are changing constantly. So there's a lot of regulatory framework that keeps changing. So you need to keep up to date with those regulatory changes. So that's one of the key differences here. We are in a stable spot with the Securities and Exchange Commission. Although regulations are still being promulgated from SEC, but in India, it's changing constantly, and you need to keep track of what are the things that you need to do from a compliance perspective and things. So those are kind of the two things. And then when we look at the stock market in particular, I think there is a lot of opportunity. There are different indexes that are available in India, and there is a lot of technologies that are coming into the market. So we've looked at the entire landscape, and our analysis says that the growth is there for the taking over the next 20 years in India.
Interesting. So the Indian market has less mature tools that gives you a better opportunity to develop them. And also the volume of the market, it's undervalued by the market, right? That people don't realize that there are a lot of opportunities to do in the Indian market, and people focus more on the US because that's kind of where people kind of orbitate around, right? Very interesting, yeah. And that gives you a greenfield opportunity that it's very interesting, yeah.
Yeah, it's a huge opportunity in India, and as I said, 300 million people that are potential targets for participation, and also if you look at the market size, it's about $5 trillion now. The stock market in India is about $5 trillion, and every day something new is coming. While there is a process of maturation from a technology perspective, there is a lot of new things that are coming. And if you look at the Indian market from a money perspective, a lot of people look at different assets for investments. Real estate and gold are kind of ingrained in the Indian DNA. Stock market is secondary, and the participation is usually through mutual funds in India. And then, a lot of people park their capital in fixed deposits, which is also called as, certificates of deposit here in the US. And the rate of return that they can get from a risk-free perspective using fixed deposit is in the 7 to 8% range, depending on the of the product. So there's a lot of money that is parked in different types of assets. And as people see that the returns are, 10% and above in the stock market, where there is a risk premium that they can get, they will start participating in the market. So I think that's a huge opportunity. Right now, out of the 1.4 billion, we look at dematerialized accounts. So there is something called as dematerialized accounts in India, where the share certificates of companies that you own are held in a dematerialized account. And the number of accounts, we track the number of accounts, that's less than 100 million today, but that's growing rapidly. And the growth of dematerialized accounts, it's growing very rapidly. And that's a huge opportunity for us.
Right. Right. Interesting. And what about inflation in India? I'm asking because I truly don't. I'm not familiar with the Indian market. Uh, because here in Mexico we're having 8% inflation every year, give or take. And I'm from Argentina, and I lived through hyperinflations and you know and all of that. And it was at that there was some situation where it was crazy because you would need to put your money um, into this fixed time investments, so you could not lose much money by inflation, right? Because they were be paying like 30%, but the inflation was 35. You were losing less than if you had it sitting in your bank.
Right. Right. Yeah. So, inflation has been, in the it has been high, but I think right now where the economy is, it's in the 5% to 6% range. And, folks can really make a real return. So there's a nominal and there is a real return, right? So what you talked about with the 35% inflation and 30% rate is you have a negative real rate of return because your returns are not coping with inflation. In India, the current treasury bill rate, which is about 3 months, 91-day tenure is about 6%, right? So that's, and that's producing a small real rate of return with inflation being in the 5 to 6% range. So inflation has always been high in India, and it's all the rate of change. So I think monetary policy is kind of tracking the inflation and setting the interest rates appropriately. But if you look at the curve of the bond investments, the term structure of the bond investments, by going longer on the spectrum of the yield curve, you can get much more than a real rate. And I haven't looked at a treasury inflated protected securities tips kind of product in India, but one can construct such a product if there is a desire. And again, this is where in the US you have tips securities which help you achieve that real rate of return, and it's inflation tested. In India, I think that's an opportunity. I haven't seen a product yet, but I think there could be an opportunity there to create TIPS type of securities which adjusts the rate based on inflation.
Right, right. Yeah, because I've done investments here in Mexico for 90 days where they give us 15%, right? And it looks great on paper, but then what I do is I say, okay, 15% minus 8%, right? That's the effective. I'm butchering the equation, right? I'm oversimplifying it, right? But my idea is to be able to, beat inflation. And what I've seen on the US side is that inflation has been going higher and higher even higher than Mexico. So my strategy is very basic on investment. Based on my experience, what used to work, based on my experience in Argentina, what used to work is properties, because I've been experiencing, in particular in Argentina, very unstable economies. So sometimes cash means nothing, right? So it wouldn't make sense to have cash. To give you an example of that, I bought a car in Argentina, and then 20 years later, we sold that car for the same amount of money in dollars, which is crazy, right? And that was the fluctuations of the market, because it was an imported car that was cheap to buy before, but now that import closed, it became more and more expensive, right? Because there was no supply of cars, right? And there was a higher and higher demand, right? So it was a um, artificial price increase, right? But anyway, I got the benefit, right, out of that, right? So tell us a little bit more about the rules-based investing. How does that work, and what are the benefits?
Yeah. So I think, one of the questions that comes up is, people are very excited about investing in things that they think that they understand. Like you look at Apple products, Apple makes iPhone, they've been growing for a long time. And, you have heard from a friend, you want to invest, right? And then you talk about NVIDIA in the US, you have heard from friends. So most of them kind of make it very emotional and personal when it comes to investing, right? I will invest in the stock. I will buy this, stock because I think it is going to go up. So the whole idea of investing, let's start there, right? Is to make money. You know, Now the question is how much money you want to make, over what term, and what is your process for doing that investment, right? Most of them work with a financial advisor, which is the right thing to do, right? Work with a financial advisor who can create a plan, set aside life goals. What do you want to achieve in your life, and how do you look at it from a financial perspective? What growth will help you achieve your goals from a financial perspective? So that's the right option for most of them. But there are many, many people in this world who are emotional about investments that they want to do it themselves. They want to participate in the action in the market. They think Apple is going to go up tomorrow because they may have an earnings event, or somebody hears a rumor that there is the next product coming up, and they want to participate. And then most of them end up losing money because of these emotional decisions. So there are three things that you need to look at. One, what is your process for investments? How much money? Second thing is, how much money are you going to allocate? Let's say I'm convinced that Apple is a stock that I want to own. How much money should I put into Apple? The third is primarily, okay, what is the time frame that I'm looking at? Am I an investor? Am I a trader? Am I looking at this for a very short term gain, or am I going to hold on to it until I retire? So those are kind of the three areas that you need to look at. And what we have done at QuantMomo is being very methodical and disciplined. So we give you a set of strategies. For example, right, you were talking about your car being worth the same because the currency has depreciated, and you have seen no change in the value of your car. So if you look at that, right, then in that case, what is a better alternative, right, in relative terms? Because we are all, Argentina is pegging its currency against the US. There are different dynamics that are going on, and one of the strategies that we have is an all-weather strategy, where we look at four different components. One is equities, gold we look at, because most of the traditional investment advice does not talk about gold. And if you look at the gold's performance this year, it's close to 25% this year, right? It has beaten all stock market averages in the US. It's done the same thing in India as well. And then, you look at commodities, which people don't talk about. And then you look at a basket of bonds, right? Across different tenors and terms and things like that. So that's one strategy that we have, which is very rules based. You can set it and forget it. Most of them call this an all-weather, sleep well at night strategy. Now, if you want good action, and you want to participate in stocks that go up a lot, momentum is your play, right? So we have a momentum strategy where we pick about 20 stocks every month, and then we enable trading those stocks through our, application, right? So through our mobile app, you can trade that. And this is an investment. You do a rebalance every month, and over the long term, you achieve an alpha significantly. So we have done some of our back tests indicate that you would achieve about 20x performance on the benchmark index, right? So that's kind of the power of momentum. Now, this is rules based. The 20 stocks that we allocate is based on, the risk that we foresee and we forecast in terms of what the risk is. And, the algorithm does not take positions, where it's concentrated, right? It's distributed in a way it is risk managed. That's kind of what we do. So there is a risk management. So the question of how much to allocate is very important. The time frame for momentum is short term. You do rebalance every month. You can do there is a lot of time frame related analysis that has gone in. We can do weekly, we can do monthly, we can do quarterly. We can enable any of that through our platform. But for most people, once a month is good enough, is what we felt. We did a survey of our audience and we did it once a month. Or whether we do a rebalance once a year. And then we have a value strategy, which is all about value stocks, right? So they have very good fundamental metrics. And, we use different characteristics in our algorithm to sort out these value stocks. And if you look at the allocation, these are kind of the three strategies that investors can allocate different proportions. Again, you want to diversify your portfolio as broad as possible so that can absorb shocks like the COVID shock or the great financial crisis shock, right? So that's kind of what we do. It's rules based in that sense. You don't really use emotion. The algorithm really sets the rules. And again, it's not for everybody. If everybody is not comfortable with somebody else's rules, that's a valid point. However, it's all based on data. So we have used data to curate these rules and make them available to our investor base. And we do discuss the rules of the strategy. And, we get a lot of questions about, can you change this rule? Should we override the rules? Again, if you start doing that, then it becomes discretionary. So there is a difference between a discretionary investor who invests based on, tip that you get from your friends or the news that you read or, the product from the company that you use. Here, it's not that. It's very mechanical, but there is a process for this mechanical investing framework, and that's what we enable our investors with. And when we launched in India, the momentum strategy performed about outperformed significantly. In 2 years we were up about 100%. Some of our early trial users, they got 100% growth in the market. So that's kind of what rules based investment is. It's process, allocation, and time frame, right? So those are kind of the three different ingredients of the rules-based investment framework. And then there are different strategies, right? So we give you different strategies so that you can allocate to each strategy and outperform the market. So the goal is outperformance of the market. That's kind of the overall goal.
Very interesting. Yes, and as you said, it's not for everybody because people might not feel comfortable with a rules-based system because they feel that they lose control, right? And it's a feeling, right? That reminds me to this story that I usually have with my wife when I'm driving, and I sometimes don't follow the Google Maps direction, right? And I go on another route, right? And she says, "Why are you putting Google Maps if you're not following it?" Right? And I'm like, "Well, I feel comfortable more. I prefer going this other route for whatever reason, right? I feel I'm beating the odds, right? Which usually that's not the case, right? But at least I feel that I'm making the right decision, right? Or maybe it's because I forgot to turn and I don't want to acknowledge that to my wife. No, I'm just joking. But it's the same thing. Right? That route is based on the information that the map have, based on the traffic, and on our position driving, we can make and feel that we're making more progress or making better decisions, but eventually we're going to. It's only a feeling. It's not actually effective, right?
Correct. And that's where emotion meets, emotion meets the person, and you step in and you use your discretion to make those decisions based on what you have seen in the past, right? So that's kind of emotional feeling, and that's something which is very hard for us as human beings to deal with emotions, right? So that's kind of what I have learned, right?
Yes, yes, and I play with virtual money investment, and I experienced that. I said I buy my stocks myself with this virtual money, right, and just playing with it, right. And but the moment we wanted to put more, real money, the level of stress went up because now the stakes are higher, right? The uncertainty, right? That was killing me. So eventually I didn't move forward with that investment strategy because of that, right? So I think that having a rules-based system will be much more appealing. And you mentioned something about backtest as a strategy, right? Can you elaborate a little bit more on what backtest means and how are you using it?
Yeah. So as I said earlier, it all it's based on data. So in financial markets, we have a lot of data, especially with pricing, right? You can find out what the price of a stock was, uh, when it began trading, let's say an IPO in 2001, and it started at a certain price. You can look at, how much the stock has appreciated. You can get daily stock-based data. You can get options data. You can get futures data. So it all begins with the historic data for a backtest. Backtest is primarily looking backwards. How did the stock behave? If you were to have a strategy, let's say, we take a momentum strategy and we say, how did the stocks in the momentum strategy behave over the past 20 years? So that's kind of what a backtest means. Testing your strategy against historic data. And the strategy itself has different variables. You look at allocation, you look at price data, you look at a bunch of things, which are beyond the scope of this call. But at a high level, the backtesting is okay. We have the strategy, we have the data. How does the strategy perform past? And does it have a good track record of generating superior returns compared to the benchmark index? And the benchmark index would be S&P 500. In India's case, we use Nifty 500, Nifty 50 as our benchmarks. So that's what you go do when you do the backtest. Now, after the backtesting, it's all about, okay, we don't know. The future cannot be known, right? So it's an unknown future. It could go up or go down. So you want to really simulate whether the strategy holds given any random price movement in stock. So this is kind of some people call it a walk forward test. Some people use Monte Carlo simulations, which is the actual framework for doing forward testing. This is kind of completely, random data. So that's kind of the forward test. So if the strategy holds very well against both the back test and the forward test, there is a merit for it to, be included in a portfolio of strategies that, one can offer. So that's kind of what the framework is from a back testing perspective. Back testing primarily means you're testing your strategy against historic data.
So, do you think that historic data can help you predict future behavior?
Historic data cannot help you predict future behavior. Historic data is looking at what is the past performance. Future is unknowable. However, when you look at the future, there are different types of outcomes, right? So the stock can go up, the stock can stay flat, the stock can go down, right? So those are kind of what the future could look like. Now, the question is, how much can it go down? How much can it go up? Relatively in what range can it stay flat? So those are kind of areas where algorithms really help. And you also look at, okay, it's all the rate of change, right? So there is this whole notion of volatility in the markets. So, can you get an estimate for volatility, given what your strategy is, and how do you use that volatility to manage your, overall port? So that's kind of what you can do. The future is unknowable. So what you can do from a predictability standpoint is look at the ranges of volatility historically and look at, what would happen if those ranges are broken and they don't hold true anymore, right? So that's kind of what I would say the takeaway from that is. So future is unknowable. All you can see is, a estimate of volatility from historic data.
How does your system trades? Are you using a brokerage account or are you trading directly?
It's a brokerage account. So our application connects with the user's brokerage account. So they come and sign in with our application, and then we enable them to connect with any of the retail brokerages in India. Same thing in the US. You can connect with interactive brokers, for example. You can connect with, you know, Robinhood. Although Robinhood does not support APIs, you can connect with multiple, brokerage systems that have a good API support. In the background, we do call APIs, and we enable the placing of the trade for a particular strategy.
What type of behavior have you find odd? Are people on stressful periods like want to break the rules and say, "Oh, I can do better," you know?
Yes, so that's a great question, actually. So, most of the investors want their stocks to go up, right? And it depends on the profile of the investor. So, the risk profile of the investor, right? When there are periods of drawdown, people really start questioning everything, right? When you have a 20% drawdown, then you're like, okay, should I continue to hold or should I? That's the question that every investor is faced with. And if you're working with a financial advisor, you are kind of protected from that decision because the financial advisors have a process for managing the portfolio, and they kind of shield the investor from that decision. But if you're an individual investor, you always have the decision to make whether to hold the position or fold it and go invest somewhere else. So that's what we have seen that the momentum strategy, what happens is as momentum stocks can go up, they can also go down significantly more than the benchmark. So that is one area where investors really don't trust the process and they will pull out, before they have had an opportunity to recoup the losses, right? So that's why, again, the lesson from the overall process that we have created is you need to diversify. So I wouldn't recommend anybody put all their eggs in one basket. Diversification is the free lunch that we have. So diversify across strategies, across asset classes, across time frames even, right? So that's what we would recommend. That, if you just focus on one strategy, which is momentum, your drawdown will be much higher than if you had momentum, value, and all weather. So you want to really diversify your strategies, your time frames, and the asset classes. That serves the purpose very well. That's what we have found. But some people want the action and momentum. They just say, okay, I'm going to invest in momentum. I'll put 10% of my capital, and then you see this behavior where momentum is not going well, and they end up withdrawing. But if they held on and continued with the rules, they would have come out much higher than what the index provided. So we have seen that. We have several graphs that we share with our customers where we show them when the drawdown happens in the index, the momentum stocks draw down more than the index. And those are times where you get tested. But, we have seen that there is a recovery and there is a path to coming out ahead. And that's what we tell our audience, right? It's like, okay, we understand there is a drawdown, but it requires patience.
Yeah, I can understand that feeling of being scared of, you're trusting a system and you see that everything is crashing, and you should continue trusting the system, but if you pull up there, then you're losing money, right? Yeah. I think Dave Ramsey said that when a stock that you bought goes down in value, you haven't lost money, because you haven't cashed out, right? So what you're losing is equity on the stock, right? And then the moment you sell the stock, that's when you lose the money, right? So if you keep it, then when the stock goes up, then you get more equity, right? So it took me a while to kind of understand that, right? And I think that he said it like that to explain people like you're not losing money until you actually completed the transaction, right? Yeah.
And that's why, risk management becomes extremely important. We have a very disciplined approach of how we allocate money. I talked about this, and that I cannot emphasize more because position sizing is very crucial when it comes to following the rules. It's like many people I see, the one of Warren Buffett's best advice is to buy an index fund and hold it. That's accurate, right? It's like, okay, but you also want to diversify across multiple asset classes, right? You want to have some gold in your portfolio, you want to have some commodities in your portfolio, you want to have some bonds in your portfolio. And the main thing is what is the percentage allocation that you want to make? And that's based on the goals that you have in your life, right? So some people who are old cannot afford to take risk in the stock market. So they probably will need to increase allocation to stable assets and manage their portfolio that way. But concentrated positioning is very bad, right? Because let's say you believe, you have a conviction and you believe that something is going to go up and you put all your money there. And then if you have a 50% drawdown, then that's not a good scenario to be in, right? So that's where the overall position sizing comes into play. How do you position size? How do you really position it based on the risk that you can forecast is where, the rules come into play quite a bit.
And the index fund is a way to distribute your risk with a very simple rule based system, right? Because basically they say, oh, we're going to buy all these shares and we're going to put them in an index, right?
Correct. So there is, the index again, there is cap weighted index, and, we have seen US being concentrated with the Magnificent Seven or Mag 10, however you look at it. But, there is an entry criteria to get into the index, right? So not all stocks on exchanges can get into the index. They're going to vet some of the stocks and, they have to be at a certain market cap, and that's when they get entry into the index. Um, but holding the index alone, that is just participation in the equity markets. You want to participate in other markets as well, so that when the equity markets are down, you have an uncorrelated performance in other markets. Like bonds could be one of the things that you could look at, because most of the traditional advice has been 60-40, which is 60% equities, 40% bonds. But I go beyond that, right? How do you really participate in commodities as well as gold as a asset? Gold has a lot of history behind it, right? We used to be on the gold standard, and currency was valued based on the gold reserves that you had. Now, we've seen over the past 2 years, gold has become an asset again that has been producing a lot of returns for investors. 20% 2 years sequentially, 20% plus returns. From a gold perspective, right? So you want to have a diversified portfolio of assets. And the best thing is to look at, okay, what is the index fund that can give me that portfolio? Index funds that can allocate across different assets and be able to manage that.
My comment about being a rules based system is very simplistic, right? But it's a way for me to kind of understand how index funds work, right? I have a relative that he has a very simple rules when he bets, right? And basically what he does is he says I'm going to spend $1,000, right? So I'm going to go and spend it as an as entertainment, right? And then and there's a reason I mentioned this, but I'll try to finish the story quickly. But the idea is, as he decides how much money he's going to spend, let's say $1,000, right? And then he sees that money as entertainment, right? So he's either he spend it on betting on a casino or going on a trip or going to lunch or whatever, right? Or but he assumes that that money is gone, right? It's fun money, right? Okay. Then if he goes and bets and loses all the money, that's it. I'm done, and he retire. He leaves, right? And that he finished his betting session there. And then if he makes more money and doubles the money that he came in, that's a moment that he leaves, right? And because on both extremes, right? Like if you're making more money, then you want to keep doing, and then you lose everything, right? And if you lost $1,000 and you say, "Oh, I wanted to get it back, so I'm going to put more and more money," right? Those two are traps that that activity has, right? But what he says is that by having that rule, then he can go and have fun in a controlled environment, right? Without risking getting into bad behaviors, right? So the reason I'm mentioning this is because I think that the in investment in stock investment there's something similar, right? If you start doing bad behaviors, you're going to lose money, right? And it's a similar because there's a risk, there is an unknown, right? So there is a similar behavior than betting, right?
Yeah, it is. It is. So, there are various books that have been written, and it's all about position sizing, and what is the optimal allocation for a particular stock. It's very similar to whether you should buy a stock, and if you lose, you don't care that you lost the money, but you participated in the action, and it's like uh, again, I don't like to use the lottery terminology, but you want to place certain bets, and it becomes again a question of how much is that, right? I think it's all about how much risk you are willing to take. It's very similar to what you described, right? You're going with a fixed mindset where you want to bet $1,000 and you want an outcome, right? Which is your happiness, and you're maximizing for a particular outcome. When it comes to investments, you can, pretty very similar, right? So you want to participate in a potential growth opportunity from a capital standpoint. But how much do you allocate? How much of the portfolio, and what is the basis for that allocation, right? So the basis for the allocation is what we look at. We profile the risk of a particular investment, and then we say, okay, here is kind of what we can feel comfortable with this based on the risk that we have seen, right? So that's kind of yeah, very good analogy that you use. But if you put with investments, it's about position sizing. What is the position size, and how much are you going to bet?
That way you distribute the risk, and the other important concept that you brought in is remove emotions out of the equation.
Correct.
So one last question. What is the roadmap for QuantMomo? Where are you planning to build next?
So I think there's a lot of proliferation of artificial intelligence today. Everybody is talking about artificial intelligence and what it can do. So one of the things that we are looking to enable our users is a financial coach framework where we can coach them on a variety of elements as it relates to their financial life. One of the challenges that we have today is your financial life has multiple products, multiple interfaces that you need to look at. You have a bank interface, you have a stock market interface, you have a retirement interface, you have an insurance interface. So there are a bunch of interfaces, and you need to, it's all fragmented, right? So you don't have a comprehensive view of what your finances look like. So one of the things is, to be able to build that comprehensive view for audiences, variety of audiences, to empower you with knowledge in terms of what your financial situation is, and then enable them to automate, the investment process, right? So in the process, we will also look at the risk profile of the person. My risk profile could be different than your risk profile based on, our age, based on our background, based on where we were, what type of income we can generate, then based on the amount of assets that we have accumulated, things like that, right? So being able to risk profile you and then being able to provide you with the correct guidance in terms of what you can and cannot do is what our roadmap will look like. So we started with rules-based investments, but then we are kind of expanding our overall scope to a full-fledged financial coach, which is all about your data. We get your data, we kind of tell you where you are from a financial perspective, and then be able to map that with your goals and provide guidance as and when needed. Right? It's not about checking in with somebody in the financial industry every year. It's about as and when I need it. Like for example, right, can I afford to buy a car today, given my finances? And many people don't know, right? They look at, okay, I have a monthly income, I can pay this much. Never really look at, okay, what is my comprehensive financial picture at this point in life? Can I really afford it? Right? That would be one example where a person would come in to the platform and they would get an answer immediately based on what their data is saying about them and their risk profile is saying about them.
Very interesting. Yes, I think that's a great use for an AI agent, because I think that the issue with AI agents is that they are non-deterministic. So, you know, adding that to the rule-based system, which is deterministic, right? Or it's much more deterministic, then it could add more risk, right? But if you use it to personalize your rules, right? I think that's a great way, because you allow the users to have a personalized recommendation, and then based on that, you go with the rules-based system that you already trust and build, right? So thank you very much for joining us today. I'm grateful for having you here, and I'm looking forward to see where you're taking QuantMomo next.
Yeah, really super excited to take QuantMomo to the next level. Really happy that you were able to have me on this show and host me on this show. Thank you very much for the time that you have given us at QuantMomo. Yeah, looking forward to future opportunities where we can engage.
Thank you.